Hi, everyone, and welcome to this second round of workshops for listed companies and financial institutions in Thailand, where, let me turn my camera on, where we will be providing training on climate risk assessments and climate-related scenario analysis. My name is Fred. I am from an environmental organization called CDP, who runs the world's most used platform and framework for corporate environmental reporting. Some of you may remember me from the previous workshop that we hosted a few weeks ago. I'm based in our Hong Kong office, where we work with large listed companies throughout Southeast Asia, including Thailand, and so I will help facilitate this webinar today. Before we get started, just a few housekeeping rules. All participants are muted on entry to avoid background noise. If you have any questions throughout the event, please feel free to add them in the Q&A box at the bottom of your screen. We have a few Q&A sessions throughout the event, and we will answer as many of them as we can. And then lastly, please also note that this webinar is recorded, and we will share a link to the recording and slide deck after the event. Before we start, I would like to briefly share some information and context as to why we are here today. This capacity building program is made possible by the UK government through funding from the Department for Business, Energy and Industrial Strategy. And the program is called UK Pact Green Recovery Fund, where PACT stands for Partnering for Accelerated Climate Transitions. This program is part of the UK's commitment to tackle climate change, and they work with partner countries and organizations to accelerate clean growth transitions and pursue greater climate action. Together with the Global Reporting Initiative, or GRI, we at CDP applied to be part of this program to deliver capacity building for listed companies in Thailand on corporate ESG issues, or environmental, social, and governance issues. From CDP's side, we will focus on global best practice when it comes to corporate environmental action and reporting in the context of the Task Force for Climate-Related Financial Disclosures, or the TCFD for short. Our partners at GRI will be focusing on how you can align business goals and KPIs with the Sustainable Development Goals, or the SDGs. We have divided these workshops into beginner, advanced, and capital markets sessions. The beginner workshops have already been completed. And again, I know many of you on the call today attended that a few weeks back. However, in case you didn't, and you are interested in learning the basics of what the TCFD is, I highly recommend that you review our beginner workshop materials, which are linked on the screen here, and the slide decks and recordings are also available on the training page for the Stock Exchange of Thailand's website. So you can also find it there. We will continue this training throughout 2021. Today and tomorrow, we are building on these beginner workshops, and we will go more in detail on some of the topics that we introduced last time. Today, the topic of the workshop is based on the feedback we received from listed companies in Thailand who answered a survey that we conducted at the beginning of the year, where we asked companies what they were most interested in learning about. After the TCFD and SDGs, which we covered last time, the most requested topics were climate-related risk assessments and climate-related scenario analysis. These are also important components in the context of the TCFD. What we will go through today, we will share more in a few slides, but we hope that the training today will help you become familiar with, in more detail, the climate-related risks in the context of the TCFD. We will then go into key elements of climate risk management and common practices that we see. We will also talk more about climate-related scenario analysis and various approaches to this. And importantly, we will go through context on what companies can do if you are starting, if you are new to any of these elements, what are the first steps that you can take, what are the resources available to support you. And since this is a fast evolving space for companies who are already conducting these types of assessments, what can you do to see if there is room for improvements? So again, thank you very much for joining us today. And a big thanks to the UK-backed Green Recovery Fund and the British Embassy in Bangkok for making this capacity building program possible. And also a big thanks to our partners at the Stock Exchange of Thailand, who is providing invaluable support in developing and rolling out this project. Here is the agenda. The training will take about 2.5 hours, and we will have a break in the middle. We are pleased to be joined by the Stock Exchange of Thailand and the British Embassy in Bangkok for opening remarks. After that, I will briefly provide a recap of the TCFD and a summary of the training we delivered in the beginner workshop. And then I will hand it over to Ms. Lau Shenyi from the Carbon Trust to provide about 2 hours of training again on climate risk assessments and climate-related scenario analysis. So if you have questions along the way, again, you can see the Q&A function at the bottom of the screen. Feel free to add questions there anytime, and we will address those during these Q&A sessions. So without further ado, to deliver the opening remarks, I am pleased to introduce Kun Ratvali Anantananund, Senior Vice President and Head of Sustainable Development Department 1 at the Stock Exchange of Thailand. So Kun Ratvali, over to you, please.
สวัสดีค่ะท่านผู้เข้าอบรมทุกท่านค่ะตลาดทรัพย์แห่งประเทศไทยในฐานะผู้ร่วมจัดหลักสูตรอบรม TCFD SDG Workshop มีวัตถุประสงค์ที่จะมุ่งสร้างความรู้ความเข้าใจให้แก่บริษัทจดทะเบียนและภาคธุรกิจเกี่ยวกับการพัฒนากลยุทธ์การดำเนินงานและการเปิดเผยข้อมูลเรื่องการบริหารจัดการด้าน Climate Change ตามแนวทางของ Tcfd Recommendations และการบริหารจัดการด้านประเด็นสังคมโดยเฉพาะเรื่องสิทธิมนุษยชนความหลากหลายและก็ความเท่าเทียมในสังคมนะคะซึ่งเป็นไปตามเป้าหมายการพัฒนาที่ยั่งยืน SDG ทุกวันนี้เราทราบกันดีอยู่แล้วนะคะว่า Climate Change เข้ามามีบทบาทแล้วก็ส่งผลกระทบอย่างมากต่อการดำเนินธุรกิจซึ่งสะท้อนให้เห็นชัดเจนนะคะจากปัจจัยความเสี่ยงของธุรกิจที่นับวันจะเป็นประเด็นความเสี่ยงด้านสังคมและสิ่งแวดล้อมมากขึ้นเรื่อยๆและผลกระทบจาก Climate Change ที่มีต่อธุรกิจก็เห็นได้ชัดเจนมากยิ่งขึ้นไม่ว่าจะเป็นความเสี่ยงและโอกาสที่เกิดจากสภาพภูมิอากาศที่เปลี่ยนแปลงไปอย่างรุนแรงการเปลี่ยนแปลงด้านกฎระเบียบที่เข้มงวดและจริงจังมากขึ้นตลอดจนการปรับตัวให้สอดคล้องกับเรื่องของ low carbon economy ที่หลายธุรกิจจะต้องออกแบบสินค้าและบริการรวมไปถึงการพัฒนาโมเดลธุรกิจใหม่ๆให้สอดรับกับเทรนด์แล้วก็สภาพแวดล้อมในการดำเนินธุรกิจในระยะยาวในขณะที่ผู้ลงทุนเองก็จะต้องวิเคราะห์แล้วก็บริหารจัดการความเสี่ยงด้าน climate ในพอร์ตการลงทุนนะคะทั้งหมดนี้ล้วนสะท้อนให้เห็นว่าประเด็นเรื่อง climate change มีผลต่อความสามารถในการอยู่รอดและเติบโตของธุรกิจและก็มีบทบาทอย่างมากต่อทิศทางการลงทุนในปัจจุบันขณะเดียวกันนะคะประเด็นด้านสังคมก็นับว่ามีบทบาทสำคัญต่อทิศทางการดำเนินธุรกิจในทุกวันนี้ไม่แพ้กันประเด็นด้านสังคมที่สำคัญไม่ว่าจะเป็นเรื่องสิทธิมนุษยชนนะคะความเท่าเทียมกันความหลากหลายต่างๆก็เป็นเรื่องที่องค์กรจะต้องคำนึงถึงนะคะแล้วก็ให้ความสำคัญด้วยไม่ว่าจะเป็นเรื่องของการดูแลพนักงานแรงงานรวมไปถึงผู้มีส่วนได้เสียต่างๆตลอด value chain ของธุรกิจดังนั้นนะคะเรื่องของการบริหารจัดการความเสี่ยง ไม่ว่าจะเป็นความเสี่ยงเรื่องของ climate change หรือว่า human rights นะคะก็เป็นสิ่งที่บริษัทจดทะเบียนควรให้ความสำคัญแล้วก็ควรจะต้องมีความรู้ความเข้าใจเพื่อที่จะสามารถนำไปกำหนดเป็นกลยุทธ์การดำเนินงานนะคะรวมไปถึงการทำเรื่อง road map นะคะการทำเรื่อง action plan ต่างๆตลอดจนเรื่องของการเปิดเผยข้อมูลการดำเนินงานให้สอดคล้องกับความต้องการนะคะความคาดหวังของผู้มีส่วนได้เสียนะคะหรือว่าแม้แต่ผู้ลงทุนก็ตามนะคะ ทั้งนี้ก็คือเพื่อสร้างความเชื่อมั่นว่าธุรกิจจะสามารถปรับตัวแล้วก็เติบโตไปได้นะคะท่ามกลางความท้าทายต่างๆที่เกิดขึ้นนะคะในปัจจุบันแล้วก็ในอนาคตด้วยแล้วก็ทุกวันนี้นะคะเราก็ต้องยอมรับนะคะว่ามาตรฐานการรายงานความยั่งยืนนะคะไม่ว่าจะเป็นมาตรฐานของ SDGs นะคะ GRI หรือ CDP เนี่ยเข้ามามีบทบาทช่วยในการยกระดับการกำหนดกลยุทธ์นะคะแล้วก็ทิศทางการดำเนินงานแล้วก็รวมถึงการเปิดเผยข้อมูลด้านความยั่งยืนของบริษัทนะคะทำให้มีกรอบมีแนวทางการรายงานที่ชัดเจนนะคะมีตัวชี้วัดที่เป็นมาตรฐานแล้วก็สามารถที่จะเปรียบเทียบเคียงกันได้สะท้อนให้เห็นถึง Impact ที่เกิดขึ้นจริงจากการดำเนินงานด้านความยั่งยืนของบริษัทนะคะอย่างต่อเนื่องสำหรับวันนี้นะคะตลาดทรัพย์ได้จัดกิจกรรมขึ้นนะคะเป็นเวิร์กช็อปเชิงลึกนะคะซึ่งจัดต่อเนื่องจากเวิร์กช็อปคราวที่แล้วที่เป็นสำหรับ beginners ในเดือนที่แล้วนะคะซึ่งเราได้รับเกียรตินะคะจากวิทยากรจาก Carbon Trust นะคะ CDP แล้วก็ GRI นะคะซึ่งทุกท่านก็เป็นผู้ที่มีความรู้ความสามารถนะคะเป็นผู้ที่มีความเชี่ยวชาญที่จะมาบรรยายให้ทุกท่านทราบในวันนี้นะคะแล้วก็หลังจากจบเวิร์กช็อปในครั้งนี้นะคะแต่ทรัพย์ก็จะเอาข้อมูลความเห็นต่างๆนะคะรวมถึงคำถามที่ท่านสอบถามกันไว้นะคะตั้งแต่คราวที่แล้วจนถึงครั้งนี้นะคะมาประมวลมาวิเคราะห์นะคะว่าบริษัทต้องการที่จะเรียนรู้เรื่องของ TCFD กับเรื่องของ SDG ในประเด็นอื่นใดอีกบ้างหรือเปล่านะคะเพราะฉะนั้นในตอนท้ายของการอบรมในวันนี้นะคะก็จะมีการเซอร์เวย์นะคะขอความกรุณาทุกท่านให้ข้อมูลในส่วนนี้ด้วยนะคะท้ายนี้นะคะตลาดทรัพย์ก็ต้องขอบคุณ UK Pack Green Recovery Fund นะคะที่สนับสนุนการจัดกิจกรรมในครั้งนี้นะคะแต่ทรัพย์ก็หวังเป็นอย่างยิ่งนะคะว่าทุกท่านจะได้รับประโยชน์นะคะแล้วก็ความรู้ที่ได้จากการสัมมนาความรู้ที่ได้จากการทำเวิร์กช็อปในครั้งนี้นะคะก็หวังว่าจะมีส่วนช่วยที่ทำให้ท่านยกระดับการดำเนินงานนะคะแล้วก็สร้างธุรกิจให้เข้มแข็งแล้วก็มีส่วนเสริมสร้างสังคมและสิ่งแวดล้อมให้ดียิ่งขึ้นไปค่ะขอบคุณค่ะ
Thank you very much, Kunratwali, for the welcoming remarks. And again, a big thank you to the Stock Exchange of Thailand, who is a key partner for us to successfully implement this capacity building program. Next, for opening remarks, I am pleased to introduce Mr. Andrew Byrne, Economic and Prosperity Counselor and a UK Permanent Representative to UNESCO with the British Embassy in Bangkok. Andrew is a British diplomat with a background in economics, energy, and business. And as the Economic and Prosperity Counselor at the British Embassy in Bangkok, Andrew oversees the UK government's engagement with Thailand on economic issues, science and technology, climate and environment, as well as sustainable development. So it's great to have you with us today, Andrew, and I'll hand it over to you, please.
Thank you, Frederick, so much for the kind introduction. Good afternoon, Kun Ratpali and ladies and gentlemen. I'm really glad to see that this workshop providing advanced training for Thai-listed companies on TCFD, climate risk assessments and climate-related scenario analysis has proved interesting to so many of you. And I have to say, actually, it's a subject that's quite close to my own heart because I used to work for Deloitte in financial services, looking at listing and reporting and so on. So it's interesting to see how this issue has progressed in the last 10 years or so. So this workshop, as you all know, follows on from the one that we ran with the Stock Exchange Thailand last month, which provided an introduction to climate risk disclosures for listed companies. Over recent decades, our global economic system has faced multiple shocks, and none more marked, of course, than the current COVID-19 pandemic. But if we look to the future, we can see another more fundamental crisis, one which unfortunately no amount of quantitative easing will save us from, and for which there will be no vaccine. I'm talking, of course, about the threat posed to our lives and economies by climate change. The United Nations Secretary General Antonio Guterres said recently that 2021 is a make or break year for climate change. Our action this year will determine humanity's future. We define catastrophic global warming as happening if there is a rise in temperature greater than 1.5 degrees C globally. That 1.5 degrees centigrade is important, incidentally, because much of the sort of triggers, the things that change fundamentally in our planet or on our planet happen between 1.5 and 2 degrees centigrade. So, for example, if we can limit global warming to 1.5 degrees centigrade, we can retain 30 to 40% of our coral reefs, whereas by 2 degrees, all of the coral reefs in the oceans are gone. And while the agreement in Paris in 2015 was an important start, if we are to prevent this catastrophic global warming, we must agree action to cut greenhouse gas emissions by 45% from 2010 levels to 2030 levels if we are, by 45% from 2010 levels by 2030 if we are to prevent a more serious scenario. Greening the global financial system will be critical to limiting global warming to help us reach the 1.5 degree scenario. That's why, as the COP26 presidency alongside Italy, the UK is prioritizing global climate finance. Whether that's about funding low carbon projects for the future, giving investors and other stakeholders the information they need to plan and invest sustainably, or helping companies and regulators analyze climate-related risk. Earlier this month at the G7 summit in the UK, the G7 members committed to work together to keep the projected global temperature from exceeding 1.5 degrees centigrade. As part of a series of commitments, we agreed historic steps to make climate reporting mandatory for corporates. Across the G7, there will be reporting requirements on business in line with those advised by TCFD. They will require more reporting on climate impacts and investment decisions. And there will also be new measures to strengthen beneficial ownership registries in order to crack down on environmental crime. The wider G20 group of nations are also set to discuss this topic shortly. The UK was the first major nation to confirm plans to mandate climate disclosure in November of last year. From this year, all UK companies with premium stock exchange listings must state in their annual reports whether they have disclosed in line with the Tcfd's recommendations. But within the next couple of years, the UK isn't alone. There are now more than 1,500 companies TCFD's recommendations, including corporates with a combined market cap of $12.8 trillion and investors with 139 trillion assets under management collectively. The TCFD disclosures has
sorry, Andrew, we have a little bit of connection issue. Yeah. Hi, Andrew. Can you hear me? Just a second, everyone. We'll
2019. I note incidentally that
Hi, Andrew. We are still having some issues hearing you. Can you hear me, Andrew?
The SEC became a TCFD supporter just in January of this year. You can't hear me anymore, or what? Right. I already.
Andrew, can you hear me now?
Yeah.
Yeah, I think yeah, we lost you for about 20-30 seconds there, just at the end. I think it was maybe the bandwidth, but I see the camera is off now, so it seems to be working again. Is it working? Yeah, Andrew, we still cannot hear you. Let me see here. Just 1 second, everyone. Okay, everyone. Unfortunately, it seems like we lost Andrew due to the connection issue. Oh, here. Hi, Andrew. I think we have you back.
Yes, I think I actually have a pretty fundamental technology problem going on. So
Yeah.
I will do what I can to finish this as quickly as I can. I'm sorry.
Yeah, no.
And apologies to all participants.
Yeah.
So I'm sorry, ladies and gentlemen, about that. I'll try and get through quite quickly. So I think I was saying from the previous workshop, you are already, I think, well aware of the potential impact of climate change on your business. So the types of risks that you may face, the importance of climate risk assessment, and how undertaking this kind of thing can present opportunities for businesses as you prepare yourselves for the future. So I hope that this 2-day session on climate risk assessment and scenario analysis will help you to answer questions about how resilient your business is, how your business can respond to different combinations of physical and transition risks, and how your firms can improve risk management practices around climate-related risk. Most importantly, I hope that this helps you understand the future impact of decisions your firms are making today, so that you can shape the right strategy for the future of your businesses. I'd like to take the opportunity to thank the Stock Exchange of Thailand for this partnership, and also to thank the Carbon Disclosure Project for its excellent work in setting this up, and our expert from Carbon Trust, who will be joining us and sharing practical experience and their insight. So thank you all so much. Apologies again for the interruption. Thank you.
Thank you very much, Andrew. Thanks again for joining us today. And yeah, it's part of the game when we do online events. We're bound to have some technical issues. So thanks very much for joining us. And yeah, we look forward to continue working closely with you in the months and year ahead on this project. Next on the agenda, I will provide a 10-minute recap and a summary of the beginner workshop, where we introduced the Task Force for Climate-Related Financial Disclosures, or TCFD, and how CDP's reporting platform can help you towards TCFD-aligned reporting. And again, just for those who are not familiar, this is some brief background on CDP. As I mentioned, we are a platform and a framework for companies to report environmental data. So what we do is to reach out to companies on behalf of our investor signatories, who now are around 600 institutional investors who would like to better understand the environmental performance of listed companies. And in addition to our investor signatories, we also reach out to suppliers on behalf of large purchasing organizations who would like to better understand the environmental risks, impacts, and performance within their supply chains. So on behalf of these stakeholders, we reach out to companies to collect environmental data through our online questionnaire. The benefit of this is that our investors can access the data from a centralized location and, importantly, in a standardized and comparable manner for their investment decision-making. Especially relevant for today's session is that our climate questionnaire is also fully aligned with the TCFD recommendations. And to understand the origins of the TCFD, we need to go back to 2015, when the Paris Agreement was adopted by nearly 200 nations. The focus of the agreement was and is to limit global warming to well below 2 degrees, preferably 1.5 degrees Celsius as compared to pre-industrial levels, as Andrew mentioned. To achieve this goal, countries commit to taking action through what is known as nationally determined contributions, or NDCs. And when a country such as Thailand provides its NDC goals, it specifies the action it will take to reduce emissions, and it also provides action plans to develop resilience to climate change. The effects of climate change are already being felt globally, and it is now impacting some countries much more than others. This slide shows the countries that have, over the past 19 years, been particularly affected by climate change. And 5 out of the 10 most impacted countries are from Asia. This includes Thailand, which faces climate change from various climate issues, such as extreme weather events, and also more and more long-term chronic changes in the weather patterns. And so to combat climate change and to successfully transition to a low carbon economy, as outlined in the goals of the Paris Agreement, more than 70 countries are currently working to establish policies to reach net zero emissions by 2050. And of these, 2 countries have already achieved carbon neutrality, and 6 more countries have incorporated net zero emissions targets into legislation. So there is a lot of momentum going on in these recent years, and it's only picking up on a policy level. So how does the TCFD fit into all of this? After the Paris Agreement was established, finance ministers from the G20 countries asked the Financial Stability Board, or FSB, to review how climate risks were priced and accounted for in capital markets, with the goal of better understanding climate-related risks to the stability of the global financial system. In summary, what the FSB found was that companies are under-reporting on climate-related risks, and that capital markets lack the necessary information to understand and manage the uncertainties associated with climate change. To address this gap, the FSB created the TCFD, again, the Task Force for Climate-Related Financial Disclosures, in order to identify the information needed by investors, lenders, and insurance underwriters to appropriately assess and price climate-related risks and opportunities. In practical terms, this meant developing a set of global guidelines for reporting on corporate environmental issues. The task force comprised representatives from corporations, auditors, insurers, banks, and other key players in the capital markets. And a few years ago, by 2017, they had produced the TCFD Recommendations, which are 11 recommended disclosures under 4 different categories: governance, strategy, risk management, and metrics and targets. Here, you can see those 11 recommended disclosures that the TCFD came up with under each of the 4 pillars. So you can see the 4 categories horizontally in the columns, and you can see then the corresponding recommendations vertically in the rows. And as you can see, there are 2 recommendations under the governance pillar on the left. And for strategy, risk management, and metrics and targets, there are 3 recommendations each. So companies who are able to report accurately and comprehensively against these 11 recommendations will take steps towards aligning to the current global best practice and meet the expectations more so of the global investor community when it comes to corporate environmental disclosure. So one of the issues here is that these recommendations are still somewhat up for interpretation, and many companies struggle to determine exactly what to report under each of these recommendations. And so this is also where CDP can come in and help. So CDP will take, or CDP takes, the 11 recommendations and turn them into specific questions with clear guidance and assessment criteria. So in other words, the TCFD recommendations provides guidelines for what investors would like to know. And then CDP's online questionnaire break down those guidelines into actionable metrics. This means that CDP provides an ideal roadmap for companies looking to disclose on environmental issues in alignment with the TCFD recommendations. And if you're interested in learning the practical steps of this, how you can report in alignment with the TCFD recommendations through CDP's platform, again, I highly encourage you to review the beginner workshop where we talked more about this, or you can reach out to us directly. And again, today's topic and training is directly linked to the TCFD recommendations. On the strategy level, the TCFD stated in their report that, and I quote, "Given the importance of forward-looking assessments of climate-related risks, the TCFD believes that scenario analysis is an important and useful tool for an organization to use, both for assessing potential business implications of climate risks and opportunities, and for informing stakeholders about how the organization is positioning itself in light of these risks and opportunities," end quote. And of course, on the risk level, the information that the TCFD recommend that you disclose on requires you to have undertaken climate risk assessments. So these are the topics that we will look more closely at today. And to do so, I am pleased to introduce our expert speaker today, Ms. Lau Xin Yi from Carbon Trust in Singapore. In her current role, Xin Yi works closely with financial institutions and corporates on a range of green and sustainable finance projects involving different financial instruments, as well as providing capacity building. And one of her recent projects involved managing a series of climate risk workshops targeted at financial regulators and banks in Taiwan. And before that, Xin Yi spent 5 years at a leading independent think tank in Singapore, the Singapore Institute of International Affairs, as a senior policy research analyst. And she has also worked with Sustainalytics, where she evaluated and benchmarked the ESG practices of publicly listed companies in various industries. So we are very pleased to be joined by Xin Yi today. And without further delay, I'll hand it over to you, Xin Yi. And I know we are a few minutes behind schedule, but no worries, take your time and we can adjust the Q&A session later. So Xin Yi, over to you, please.
Thank you so much, Fred. Hi, Kun Rivali, the CDP team, and everyone on the line. I'm Sini. I'm the Green Finance Lead of Southeast Asia at the Carbon Trust, and I'm based in Singapore. My role involves delivering and expanding our green finance services in the region. I'm very grateful to the organizers and the partners for inviting me to deliver this webinar today. I would like to begin with a brief introduction about the Carbon Trust. So the Carbon Trust is a not-for-dividend sustainability consultancy with a mission to accelerate the move to a sustainable low-carbon economy. We are headquartered in London, and we have a global team of more than 200 employees. Our team of experts work with businesses and organizations across the world, with offices in the UK, China, Singapore, Amsterdam, Mexico, and South Africa. We partner with businesses, organizations, and governments around the world to help them lead the way to a more sustainable future, from setting strategic direction, footprinting, and target setting, to energy systems and climate action plans. We support our clients to navigate the risk and opportunities of climate change. Our webinar today takes us on a deep dive on the topic of climate-related risk management, where we will talk through the background followed by the risk management sections as found in the TCFD Recommendations, as well as the Climate Financial Risk Forum Guide 2020. There will also be time for the participants to raise questions towards the end of our session. In the first section, we would like to start off with an introduction and background. Before we start diving into climate risk, I think it is useful for us to be briefly reminded why we are talking about it. We as humans are estimated to have caused about 1 degree of global warming above pre-industrial levels, and 1.5 to 2 degrees is scientifically acknowledged as the maximum temperature rise that can take place before the effects become dangerous and even catastrophic. In the absence of policies, global warming is expected to reach 4.1 degrees to 4.8 degrees above pre-industrial by the end of the century. If we consider current policies in place around the world, this is projected to reach or to result in about 2.9 degrees warming. Limiting warming to 1.5 degrees above pre-industrial levels by 2100 means that we must peak by 2020, we must reduce by 45% by 2030, and we must achieve net zero emissions by 2050. It is well worth noting that half a degree beyond 1.5 degrees will significantly worsen the risk of biodiversity loss, drought, floods, extreme heat, and poverty for hundreds of millions of people. So if we put this into context with the impact of COVID last year, the level of emissions are set to fall by 8% in 2020 as a result of the pandemic. But that's not enough. Global emissions will need to reduce by 7.6% every year this decade to limit the warming to less than 1.5 degrees above pre-industrial levels. We therefore know that climate risk can only increase from this point on. We know it is happening, we know it is foreseeable, and it is systematic. So how do we define climate risk? We typically split them into two categories. So the first, physical risks that arise from the impact of extreme climatic events, or the impact of rise in sea levels, loss of ecosystem services, for example, water shortage, degradation of soil quality, or marine ecology. And the second will be transition risk that comes about from efforts to address climate change, including changes in public policies, technology breakthroughs, shifts in investors or public sentiments. So examples are carbon tax, EV technology, public sentiments towards plastic, and also investment in coal. If you could look to this slide with me, the risks here interact, and how they will materialize depends on actions of consumers, corporates, and governments, as well as advances in technology. So with a complete failure to act, we will see physical risk dominating and a complete climate breakdown and large environmental and economic impact. A fully orderly transition is unlikely, but if we reach Paris, we will probably get considerable transition risk materializing, but with less extreme physical risk. If we see a very late but large shift on policy, we can see high transition risk materialize. Let's now briefly talk through how climate risk transmits into financial risk. When we think about financial risk, we think about credit risk, liquidity risk, market risk, underwriting risk, and operational risk. So how does climate risk, transition, and physical translate into financial risk? With transition risk, firms can see their earnings decline, businesses disrupted, and funding costs increase because of policy action, technological change, and consumer and investor demands changing. And that means there's impact on the market, credit, and liquidity risk. The share prices of coal mining companies already reflect this carbon discount as well as higher financing costs. Households can also be affected as their jobs might shift or assets become stranded, and that means credit and market risk. Physical risk can materialize directly through exposures to firms and households that experience climate shocks like flooding and forest fires that leads to increased default risk of loan portfolios or lower value of the assets. So for example, rising sea levels and a higher incidence of extreme weather events can cause losses for homeowners and diminish the property values, leading to greater risk in the mortgage portfolios. Corporate credit portfolios are also at risk, as highlighted by the bankruptcy of California's largest utility, Pacific Gas and Electric. And with changes, climate change causing also prolonged droughts in California that increase the risk of fires from their operations. Tighter credit conditions might follow, and in particular when climate shocks affect many institutions simultaneously, this causes a feedback loop. The efforts to mitigate and adapt to climate change also brings about opportunities. These climate-related opportunities will vary depending on the region, market, and industry in which the organization operates. On this slide, we see examples of what climate-related opportunities look like. So if you look, to me, the first would be resource efficiency. There is growing evidence and examples of organizations that have successfully reduced their operating costs by improving the efficiency in their business activities, in particular in relation to energy efficiency, but also broader materials, water, and waste management. Innovation in technology is assisting this transition, for example, retrofitting buildings and developing electric vehicles. Resource efficiency could also be seen in increased production capacity, resulting in increased revenues. The second will be looking at investments in renewable energy capacity that have exceeded the investments in fossil fuel generation. So organizations that shift their energy usage towards low emission energy sources could potentially save on annual energy costs. This also reduces exposure to greenhouse gas emissions and also makes the organization less sensitive to changes in the cost of carbon. Organizations that innovate and develop new low emission products and services may improve their competitive position and capitalize on shifting consumer and producer preferences. These include consumer goods and services that emphasize the product's carbon footprint in the marketing and labeling, as well as producer goods that focus on reducing emissions. Next, organizations that proactively seek opportunities in new markets or types of assets may be able to diversify their activities and better position themselves for the transition to a lower carbon economy. New opportunities can also be captured through underwriting or financing green bonds and infrastructure. And also the last point on this slide involves looking at resilience. So climate resilience means that organizations will have to develop adaptive capacity to respond to climate change and to better manage the associated risk and seize opportunities. This may be especially relevant for those with long-lived fixed assets or extensive supply or distribution networks. A climate resilient organization will benefit from increased reliability of supply chain and the ability to operate under various conditions. Let's move to a poll question. So if you could see on this slide, the question we want to hear from you is which of the following shapes climate change related risk and opportunities, and our organizers have raised a poll for you to respond. Okay, let's give maybe about 1 more minute. Okay, so we have the responses, and as we can see, most people would have picked the first, third, fourth, and fifth options, which are correct. Thank you so much for your participation. So let me explain a little more about the different options. So the first option looks at regulatory requirements that are related to climate change, and we mentioned about carbon tax, so it makes it more costly for carbon intensive sectors to be operating in the future. The third option on technological breakthroughs will affect the competitiveness of certain organizations, their production and distribution costs, and ultimately the demand for their products and services from end users. The next option is on consumer behavior shifts, which could lead to high demand for products that are sustainably sourced or produced. And the last option, looking at the physical risk, we are seeing increased severity of extreme weather events that could affect organizers' premises, operations, supply chain, transport needs, and employee safety. Let's move to the next part of our webinar. So with this context in mind, we'll dive into the TCFD recommendations and share Carbon Trust's experience of meeting these recommendations in practice. The framework on this slide lays out the recommendations that is split into 4 core areas of governance, strategy, risk management, as well as matrix and targets. The first is governance, looking at the role of senior leadership in understanding, engaging around climate, as well as being accountable. The second, having taken responsibility, is the ability of the business to scan the horizon, to translate the external pressures of the climate into internal decision-making, and also to identify impacts before they manifest, which then leads to developing the strategy. This is also a key step to understanding climate-related opportunities for the business. The third is having identified risk, your risk management process for managing this risk and also minimizing the negative outcomes. The fourth is how your knowledge of potential risk and opportunities is translated into means of tracking and reporting with suitable metrics and targets in a way that is accessible to your stakeholders. In considering your response to any of these areas, it is important to focus on how your approach relates to the financial outcomes. The 4 overarching recommendations are supported by key climate-related financial disclosures in the next slide, which is referred to as recommended disclosures. This builds out the framework with information that will help investors and others understand how reporting organizations think about and assess climate-related risk and opportunities. The risk management pillar is aimed at evaluating an organization's overall risk profile and risk management activities. To do so, we need to understand how an organization's climate-related risks are identified, assessed, and managed, and whether those steps are integrated into existing risk management processes. The recommended disclosure is categorized into 3 parts. Part A involves describing the organization's processes for identifying and assessing climate-related risks. This means that organizations should explain their approach to determining the relative significance of climate-related risk and the factors considered, such as existing and emerging regulatory requirements. Doing so enables the organization to communicate the breadth of factors considered, both in terms of different risk factors, but also whether the full value chain is included. It is also important to report the steps taken to assess the potential size and scope of identified climate-related risk, alongside the definitions of risk terminology or references to current risk classification frameworks used. Moving from identifying and assessing, Part B concerns the organization's processes for managing climate-related risks. This includes how organizations make decisions to mitigate, transfer, accept, or control those risks. Organizations should also describe their processes for prioritizing climate-related risks. Part C then looks at how the steps for identifying, assessing, and managing climate-related risks are integrated into the organization's overall risk management. There are 3 ways to treat climate risk, which are first, a standalone risk type, second, a cross-cutting risk, or third, both cross-cutting risk as well as a standalone risk. If climate change is seen as a standalone risk type, then the necessary frameworks and policies need to be developed accordingly. In the case of a cross-cutting risk type, organizations can consider implementing a work plan to progressively update the relevant risk type frameworks and policies, prioritizing as necessary based on the relevance, materiality, and the resourcing. To produce reporting that's aligned to the TCFD recommendations, we turn our focus to the process. Our approach to TCFD projects is based on the idea that the risk evaluation process has to be cost efficient. Focus on what is material and critical to decision making and avoid getting lost in the detail. The figure on this slide illustrates the practical steps a company can take to set the foundation for a TCFD aligned disclosure. It is probably helpful to break down the practical steps into a series of actions that build upon each other. The first step is to identify risk and opportunities. We recommend organizations to compile a long list of climate-related risks and opportunities relevant to the organization, such as the specific company characteristics and the industry in which it operates. This is achieved through desk-based research, data analysis, and workshops or interviews with relevant stakeholders. We would like to ensure that a holistic and comprehensive review of potential risks and opportunities is taken to avoid focusing on the obvious or the easy things. This is achieved by classifying the risks and opportunities on predefined categories to identify trends and hotspots. Categories can be related to the drivers of risk and opportunities, such as the relevant TCFD category, their root cause, and the time horizon over which they can occur, and also to the impact that they have on the company, such as the value chain stage, financial value driver, and market or the geography. In the second step, this entails prioritizing risk and opportunities using scenarios. This is by assigning scenario-driven parameters and financial metrics to the risk and opportunities. Parameters are scenario data that can be used to represent the risk driver, such as temperatures and weather patterns or carbon pricing projections across scenarios. Financial metrics are company-specific financial indicators that are affected by each risk or opportunity, such as specific cost items or revenue streams. This is very important and valuable to understand what happens to the organization and not just what is happening to the market, economy, and society. Climate risk necessarily increases, so considering multiple scenarios is valuable instead of assuming a business as usual or what we call a BAU scenario. We build on the previous step by scoring and prioritizing the risk and opportunities against detailed criteria. The data collected on scenario-driven parameters and financial metrics can be translated into comparable outputs, which can in turn be used to assess the most substantive risks and opportunities and compile a short list. For the third step, we quantify the financial impact by calculating the value at stake. This enables us to understand the cumulative loss or value creation between the BAU scenario and the analyzed climate scenarios. The BAU scenario refers to a scenario for future patterns of activity which assumes that there will be no significant change in people's attitudes and priorities, or no major changes in technology, economics, or policy, so that normal circumstances can be expected to continue unchanged. The fourth step pertains to identifying responses to manage outcomes of the risk and opportunities. This includes analyzing results to identify appropriate managerial responses in order to mitigate the risk and capitalize on the opportunities. We'll just examine the TCFD recommendations, focusing on guidance applicable to all sectors. As companies step up their climate-related financial disclosures, it's essential that such information is likewise incorporated into decision-making processes of the financial sector, and we want to consider the Climate Financial Risk Forum Guide 2020, specifically the Risk Management chapter. This chapter represents the output from the cross-industry risk management working group of the UK's Prudential Regulation Authority and the Financial Conduct Authority's Climate Financial Risk Forum. The document contains information on approaches to managing the risks associated with climate change and the views on good practices at the time of production. The guide is aimed at banks, asset managers, and insurers of all sizes, and it is split into the following topics, which were considered the most relevant for climate risk management. Our webinar will focus on the first 4 topics indicated with the red asterisks. To facilitate our understanding, I have structured the content around 3 phases: define, implement, and achieve, where it is relevant and applicable. So let's go through each phase in more detail. Effective governance should ensure that there is understanding, oversight, and accountability for financial risk arising from climate change, or what we collectively call climate risk, at all levels of an institution. The board has ultimate accountability for the long-term health and resilience of a firm. As is the case with established financial and non-financial risks, the board's understanding and oversight of the firm's approach to managing climate risk is key to embedding effective governance. Next, the slide provides a suggested approach to establishing board governance. So firstly, we should be delivering a tailored training program to the board on climate risk, and also to consider using external experts where necessary. Second is to update the board committee terms of reference to include climate risk. Third is to provide periodic regular updates to the relevant board committees on 2 topics, namely the firm's progress in preparing for and implementing climate risk management, and also the risk reporting matrix, where we will look more closely at risk appetite and the matrix being developed. Fourthly, the board is also to provide review and also to question on a few points which are undue or unexpected climate risk concentrations, the firm's strategy or corporate plan, considering the climate risk profile through a short, medium, and long-term lens. Also to look at materiality assessments and scenario analysis by climate outcomes and time horizons. And also, last but not least, emerging regulatory, reputational, and legal obligations. The ultimate goal for firms is to design and implement the governance approach for climate risk akin to established financial risk, while addressing the climate risk-specific nuances where necessary. One potential indicator of the firm's quality of climate risk governance should be based on the extent to which climate risk management is integrated effectively into established risk management. This slide captures elements of good practice, such as effective management and oversight from the board, appropriate allocation of senior management responsibility, as well as clear roles, responsibilities, and accountability across all 3 lines of defense. To further illustrate the roles and responsibilities, the first line of defense focuses on client engagement and assessing their climate risk. The second line of defense establishes the framework, tools, and delivers the climate risk training. And the third line of defense will be responsible for reviewing the control design and execution. We'll move to the next topic on risk management frameworks. Risk management frameworks are a key means to operationalize risk governance. In the case of climate risk, this should be integrated into existing enterprise risk management frameworks strategically and in line with board-level risk appetite. As described earlier, there are 3 ways that we approach climate risk and develop risk management frameworks, where we treat climate risk as a standalone risk type, a cross-cutting risk, or both cross-cutting risk and as a standalone risk. So firms can determine which is the best approach by doing a materiality assessment of climate risk. We'll illustrate this process using a diagram on the next slide. At the top of the diagram, the company performs a materiality assessment. Factors to consider in a materiality assessment include the firm's exposure to physical and transition risk. Exposure could be associated with both the firm's own property and its business model, including concentrations of risk at the portfolio and transaction level and by geographical footprint. The firm then identifies the risk types which are impacted by climate change and decides whether to handle the climate risk as a standalone or a cross-cutting risk type. And this in turn informs the frameworks and policies needed. You may wonder what constitutes good practice for climate risk framework. The guide lists the following elements, such as treating climate risk as a cross-cutting risk type that manifests through most of the established standalone risk types. Whether treated as a standalone risk or a cross-cutting risk type, linkages of climate risk with established risk types should be in place and understood in the company. There should also be tools to identify and evaluate physical and transition risk and to set up a uniform risk taxonomy and risk categories both for individual clients and transactions and at an aggregate portfolio level. This is done with a view to assess these risk concentrations. In defining the firm's appetite for adopting good practice or the extent to which the firm chooses to adopt good practice, consideration should be given to the cost and resourcing needs. The next topic we'll look at is risk appetite. Risk appetite should reflect and communicate the level of climate financial risk that an organization is willing to take. And this needs to be appropriate to the business model. A firm's risk appetite may incorporate broader considerations based on environmental, social, and governance, or what we call ESG, reputational risk, or corporate responsibility, such as a no-harm approach that may already be in place within the organization. Having a climate risk appetite can enable institutions to initiate preemptive risk monitoring and mitigation. Metrics in the form of quantitative or qualitative measures are important to allow the business and risk committees to monitor the risk profile. In a case where climate risk is a standalone risk category, the risk appetite should also have a clear, plain English statement which expresses the firm's acceptable risk level. As the ability to monitor climate risk becomes more sophisticated, institutions should begin to develop a series of metrics. The risk management chapter provides different examples of quantitative metrics. This slide focuses on two of such metrics, which were chosen for our illustration purposes. So for example, metrics that are related to monitoring serves to alert the management to a potential change, which could mean that risk appetites may be breached. In practice, this could mean putting a percentage limit on exposures or investments in high transition risk industries. Some initial steps to define a climate risk appetite involves firstly thinking about business strategies, the existing portfolio, and the type of climate risk encountered. As an example, the banking sector may be more vulnerable to transition risk if they are providing long-term loans to clients that may be affected by climate policy. Secondly, engaging the board to probe specific aspects of risk appetite, and the risk management chapter contains a list of potential board questions to engage their tolerance for climate risk. Thirdly, developing and improving a qualitative statement. This is followed by identifying metrics and associated set of thresholds which allow clear monitoring through a red, amber, green status or similar, and provide an early warning system which can prompt action as required. In the longer term, it is important to assess how metrics can best include the results from scenario analysis and impact assessments or trend analysis, such as weather-related catastrophe losses over the years. Climate-related risks manifesting through transition and physical channels are considered as systemic risks, which could impact the stability of the financial system. Risk assessment of the financial risk as well as the non-financial risk is important to measure, monitor, and mitigate the risk within a firm's appetite. Scenario analysis is a key risk and business analysis tool to assess the impact of climate change, especially given the underlying uncertainties in how and when risk will manifest. More details on scenario analysis will be covered in the next part of our webinar. The diagram illustrates the financial risk impacted by climate risk. In this section, we want to focus on 4 risk categories on the right-hand side, which are insurance underwriting risk, credit risk, financial market risk, and operational risk. These risks were considered by the Risk Management Working Group to be the most material and applicable across the financial sector. On this slide, we define 4 types of climate-related financial risk. In the case of insurance underwriting risk, increased climate-related litigation activity against fossil fuel companies and other greenhouse gas emitters carry financial implications. Insurance losses can be associated with valuation of the liabilities and pricing, particularly affecting, first of all, general liability and directors and officers cover due to climate-related litigations, and secondly, credit and surety cover related to stranded assets. On the credit risk side, credit risk analysis will consider climate impacts upon all P&L, cash flows, and balance sheet metrics. Risk due diligence increasingly incorporates a qualitative assessment of the client's board's understanding, commitment, and communication on the issue. In the context of climate change, financial market risk is defined in the following context. So first is the market value or MV loss due to societal, legal, and technological response to climate change, particularly affecting bonds and loans, commodities, and equities, or the MV loss due to concern over actual climate or weather events. Physical risks will particularly affect property or real estate and commodities, but can also impact corporates more broadly, such as the impact of rising temperatures or loss of water supply on production facilities. In addition, operational risk can materialize, for example, when the increasing frequency and severity of weather events affect the operations of financial institutions. The next slide captures steps to implement climate change risk management effectively, targeting the different financial risks. Under insurance underwriting risk, we see 4 steps, which are to research on climate change. Firms need to define which information is relevant for them based on their exposures and access the relevant research channels. Next is also to define an adequate risk appetite. It is important to have clarity around the materiality of climate change factors and the relevant time horizons. Firms may leverage existing risk management processes and tools for the assessment of climate change risk. And also, it's important to establish risk mitigation plan, as this can help firms to stay within the risk appetite under a forward-looking perspective. Depending on the business model, a long-term perspective up to 10 to 30 years may be adopted. As with all risks, primary responsibility to address credit risk should lie with the first line of defense, with risk being the second line. Formal training is needed to educate both lines of defense regarding the terminology, matrix, and the bank policy. The first line of defense should also be responsible for engagement with clients that appear to be lagging. Sustainability needs to be built into all client discussions and be used to inform consideration of both risk and opportunities. The bank should maintain a monitoring or exclusion list for non-compliant corporates. As for financial market risk, implementation will vary depending on a firm's risk systems and organization. In the short term, leading practice calls for the use of tools and systems to incorporate climate risk as part of qualitative sector and company analysis and practical real asset evaluation. Portfolio monitoring and climate reporting is prevalent, and in certain asset classes, reinforcing climate risk with stewardship and voting practices is possible today. In the medium term, scenarios will evolve to include risk appetite limits within climate financial risk management, the management of operational risk arising from climate change, whether from physical or transition risk, should be fully incorporated and mapped into the operational risk management cycle. Examples of near-term steps to manage operational risk include developing and implementing, where appropriate, the risk appetite statements, operational limits, and triggers, setting out the operational risk the company is willing to bear. Exposures against these limits can then be monitored and reported on an ongoing basis, recording or categorizing any climate-related operational losses or events, and include the losses or events in the BAU risk reporting. Incremental updates to management information are likely to be required as sophistication, capabilities, and data increase. So as we come to the end of this segment on risk management, here is a summary of what we covered today. Climate risk can be categorized as physical risk and transition risk, and both of them carry financial impacts. Those who proactively take steps to mitigate and adapt to climate change can also reap opportunities such as resource efficiency, a more diversified market, as well as climate resilient supply chain. This can generate financial benefits. Risk management is one of the core areas in the TCFD recommendations, and our webinar today examines the steps which can be taken to implement risk management across all sectors, as well as the recommended disclosures. It's important that the risk evaluation process is cost efficient. The principle is to focus on what is material and critical to decision making and avoid getting lost in the detail. Another source of information is the Climate Financial Risk Forum Guide 2020, specifically the risk management chapter aimed at banks, asset managers, and insurers of all sizes. Our webinar today covered 4 topics within this chapter, namely risk governance, risk management frameworks, risk appetite, as well as risk assessment. Some of the information may be more relevant for different companies. However, the evolving environment and commercial realities have heightened the urgency for corporates and financial institutions alike to develop an understanding of their vulnerabilities and assess the strategic and business opportunities. That brings me to the end of the first part of our workshop. I'll pass the time to Fred. Thank you.
Thank you very much, Xinyi, for the comprehensive introduction to climate risk assessments. Yeah, it's really interesting to hear. I hope also for the participants that this was useful for you as well. In the next section of the workshop, Xinyi will provide more training, this time on climate-related scenario analysis. But before that, we now have some time for Q&A, and we will also have a short break so that you can answer emails or get a drink and stretch your legs. So before that, if you have any questions, please add them in the Q&A chat now, and we will do our best to answer them. So Xinyi, there is one question for you here. If our board of directors monitors sustainability, strategy development, and risk management, which both have climate risk evaluation and actions, is it necessary for the board of directors to have a particular statement on climate risk?
Hi, Fred. Can you hear me?
Yeah, I can hear you.
Thank you so much. Thank you for the question. I think that's a really good question. So as you also explained in terms of the roles of the board, we see that it's quite important to have both the process, but also the end goal in mind. So it's not just about having the board's involvement and also ensuring that there is accountability, but the whole purpose of the statement is to be able to focus the organization as to what is the goal, what is the risk appetite, where do we see the boundaries of you know, our risk management processes, and what needs to be taken into account, especially if we want to ensure that everyone is moving in the same direction and we are not overexposing the organization to certain physical and transition risks. So the guide itself provides a good practice, and a statement is something that we feel increasingly needed in the market to be able to understand where everyone is heading and what is the level of risk appetite and tolerance for individual organizations.
Thank you, Shini. And yeah, also just to briefly add to this from CDP's side. So I think it's an interesting question because, you know, in Asia Pacific alone, we have about 3,000 companies responding to CDP, and a question that we get a lot from companies who are responding for the first time is that, you know, many of them will say that we don't have any, you know, climate risk elements or climate risk management elements to report on. But as this first question that we got, you know, even though it's not documented or reported, many companies do have climate governance or climate management mechanisms in place already. It's just not that it's not always formally defined. So there is a lot of things like this that companies are already doing that you could use in your TCFD related disclosures. Shini, one more question for you here. Can you provide an example of the types of risk? You mentioned standalone, cross-cutting, and both. What is the difference and why the need to categorize it like this?
Yes, happy to do so. So the whole idea of categorizing the climate risk is to be able to understand what type of, you know, frameworks, policies may be needed and tailored to the different profiles or the structure of the organizations. And the reason why we would consider some risks to be more standalone could be in terms of the markets where they operate. So if you think about Singapore, for example, we often talk about rising sea level, but that's also the nature of how Singapore is in terms of our geographical makeup. And so we think about Singapore from a climate risk perspective, we'll be looking at it as a physical risk, but rising sea levels may not apply to companies with operations in more landlocked type of locations. So you could then say, okay, certain types of risks, for example, like rising sea levels may not be applicable to other types of businesses or operations which are not maybe island states, for example. So this is why it is quite important to always customize it to the nature of the structure of the business, what kind of exposures, what kind of markets you are operating in, and therefore what would be the types of transition or physical risks that could be affecting the operations and the sustainability of the company.
Thank you, Shini. And also in the follow-up, you know, we can also provide some of the from CDP side, some of the typical case studies and examples that we see companies report on these types of different types of risks. So we will include that in the follow-up email. We have a few more questions in the chat, but I think we will save them for the next Q&A session that we have later in the event. Thank you very much for sending in the questions, and please do keep sending them in. But now for the next 10 minutes, let's take a break, and then once we return in 10 minutes, we will share more information about climate-related scenario analysis. So we will start at 3 p.m. So yeah, take a quick break, and we look forward to seeing you in 10 minutes. Thank you. Okay, everyone, welcome back. I hope you had a nice and quick break. So now for our second part of our webinar, this is the final section of today's training. So we will have another 45 minutes of training on climate-related scenario analysis, and then we will have 15 minutes again for some Q&A. And as Kunrad Vali mentioned at the beginning of the workshop, we would really appreciate your feedback. We have a questionnaire that we kindly ask you to fill, and I will share the link with you at the end. So please stay for that. So yeah, to hand it back to our colleague at the Carbon Trust, Xin Yi, I'll hand it over to you to go into climate-related scenario analysis.
Thank you so much, Fred. Can you hear me?
Yeah, I hear you well.
Great. Welcome back to the second part of our webinar. This part of the webinar is where we will focus on climate scenario analysis. We begin with an overview of this topic, followed by unpacking the relevant guidance from the TCFD Recommendations and the CFRF Guide. We will also look at a case study to help us apply what we learned today. Participants will be given time to raise questions during the Q&A segment. So an introduction and background to this, scenario analysis is a process for identifying and assessing the potential impacts of a range of plausible future states under conditions of uncertainty. Scenarios are hypothetical constructs and not designed to deliver precise outcomes or forecasts. They provide a way for organizations to consider how the future might look if certain trends persist or certain conditions are met. In the case of climate change, its most significant effects are likely to emerge over the medium to longer term. Individual organizations find difficulty in understanding the potential effects of climate change due to the uncertain timing and magnitude of the impacts. Scenario analysis presents one way to help organizations consider how their climate-related risks and opportunities may evolve and the potential implications under different conditions. This in turn enables organizations to appropriately incorporate the potential effects in their planning processes. Scenario analysis can be qualitative, relying on descriptive, written narratives, or quantitative, relying on numerical data and models, or some combination of both. Qualitative scenario analysis explores relationships and trends for which there is little or no numerical data available. Quantitative scenario analysis can be used to assess measurable trends and relationships using models and other analytical techniques. Both rely on scenarios that are internally consistent, logical, and based on explicit assumptions and constraints that result in plausible future development paths. What are some reasons to consider using scenario analysis for climate change? First, scenario analysis can help organizations to consider issues like climate change that have the following characteristics. First is that possible outcomes are highly uncertain. So for example, the physical response of the climate and ecosystems to high levels of GHG emissions in the atmosphere. It could also be a case of outcomes that materialize over the medium to longer term, as well as potential destructive effects that, due to uncertainty and complexity, are substantial. Second, scenario analysis can enhance organizations' strategic conversations about the future by considering in a structured manner what may unfold that is different from business as usual. Third, scenario analysis can help organizations frame and assess the potential range of plausible business, strategic, and financial impacts from climate change and the associated management actions that need to be considered in strategic and financial plans. This may result in more robust strategies under a wider range of uncertain future conditions. Fourth, scenario analysis can help organizations identify indicators to monitor the external environment and better recognize when the environment is moving toward a different scenario state or to a different stage along a scenario path. Organizations can in turn reassess and adjust their strategies and financial plans. Finally, scenario analysis can assist investors in understanding the robustness of organization strategies and financial plans, and in comparing risk and opportunities across organizations. One of the task force key recommended disclosures focuses on the resilience of an organization's strategy, taking into consideration different climate-related scenarios, including a 2 degrees or lower scenario. Disclosure of how an organization's strategies might change to address potential climate-related risk and opportunities is key to better understanding the potential implications of climate change on the organization. Let's take a closer look at the TCFD recommendations and its guidance on scenario analysis. As you might recall, in the earlier part of our webinar, we learned that there are 2 major categories of climate-related risk, which are transition risk as well as physical risk. Exposure to climate-related risk vary across sectors, industries, and individual organizations. Transition risk scenarios are particularly relevant for resource-intensive organizations with high GHG emissions within their value chains, where policy actions, technology, or market changes aimed at emissions reductions, energy efficiency, subsidies or taxes, or other constraints or incentives may have a particularly direct effect. A key type of transition risk scenario is what we call a 2-degree scenario. Under the Paris Agreement, nearly 200 governments agreed to strengthen the global response to the threat of climate change by holding the increase in the global average temperature to well below 2 degrees above pre-industrial levels, and to pursue efforts to limit the temperature increase to 1.5 degrees above pre-industrial levels. A 2-degree scenario provides a common reference point that is generally aligned with the objective of the Paris Agreement and will support investors' evaluation of the potential magnitude and timing of transition-related implications for individual organizations, across different organizations within a sector, and across different sectors. A wide range of organizations are exposed to climate-related physical risk. Physical climate-related scenarios are particularly relevant for organizations exposed to acute or chronic climate change, such as those with long-lived fixed assets, locations, or operations in climate-sensitive regions, as well as reliance on the availability of water. Physical risk scenarios generally identify extreme weather threats of moderate or higher risk before 2030 and a larger number and range of physical threats between 2030 and 2050. Organizations typically focus on the consequences of physical risk scenarios over shorter time frames that reflect the lifetimes of their respective assets or liabilities, which vary across sectors and organizations. Although there are certain sectors with greater exposure, all sectors and parts of society will be exposed to risk. As a systemic risk factor, it is important for companies to consider what other sectors or infrastructure they are reliant on. The task force recognizes that organizations will be at different levels of experience in using scenario analysis. For organizations just beginning to use scenario analysis, a qualitative approach that progresses and deepens over time may be appropriate. For organizations with more extensive experience in conducting scenario analysis, greater rigor and sophistication in the use of data and quantitative models and analysis may be warranted. The choice of approach will depend on an organization's needs, resources, and capabilities. In conducting scenario analysis, organizations should strive to achieve first transparency around the parameters, assumptions, analytical approaches, and timeframes. Also comparability of the results across different scenarios and analytical approaches, adequate documentation for the methodology, assumptions, data sources, and analytics, consistency of the methodology year over year, sound governance over scenario analysis conduct, validation, approval, and application, as well as the effective disclosure of scenario analysis that will then inform and promote a constructive dialogue between investors and organizations on the range of potential impacts and resilience of the organization's strategy under various possible climate-related scenarios. In applying scenario analysis, organizations should consider general implications for their strategies, capital allocation, and costs and revenues, both at an enterprise-wide level and at the level of specific regions and markets, where specific implications of climate change for the organization are likely to arise. Financial sector organizations should consider using scenario analysis to evaluate the potential impact of climate-related scenarios on individual assets or investments or assets in a particular sector or region, or underwriting activities. By using widely applied scenarios, organizations can achieve transparency and comparability of results. The TCFD recommends the use of temperature-based scenarios. These are comprehensive and holistic scenarios analyzing how the world might develop and the corresponding impacts that these pathways have on average global temperature and resultant climate change. There are a few types of scenarios. First, a smooth and orderly transition to a low carbon economy, which is associated with a global average temperature increase of 2 degrees or lower. Second, a lack of transition or transition based on known technology and policy developments, or what we see as current policy scenarios, which result in higher temperature increases. Other scenarios move away from this dichotomy and can describe this orderly transition where stringent policies kick off at a later date to meet the climate commitments. The TCFD also recommends that organizations use a 2 degrees or lower scenario in addition to 2 or 3 other scenarios most relevant to their circumstances. For companies undertaking scenario analysis for the first time, it is advisable to initially consider a scenario which outlines an orderly transition to a low carbon economy, which will allow for analyzing transition risk, and another non-transition scenario, which would highlight physical risk. In practice, this means focusing on a scenario consistent with the Paris Agreement goal of limiting warming to 2 degrees, and another scenario aligned to current policies and pledges leading to approximately 3 degrees of warming by the end of the century. More advanced companies that gain familiarity with scenario analysis should consider looking at extreme scenarios such as abrupt and disorderly transitions and the breach of climatic tipping points. These could include scenarios aligned to the highest ambition of the Paris Agreement of limiting warming to 1.5 degrees, as well as no additional policy scenarios exceeding 4 degrees of warming. Besides the different temperature increases, scenarios also differ in the level of granularity offered, the sectorial focus taken, the driving data sets and assumptions, and the underlying narrative described. This means that companies can choose between a wide set of resources, and often scenario data comes from a variety of sources depending on the risk or opportunity in question. When selecting scenario data, companies should consider the general implications for strategy, capital investment, cost and revenue, both at a company level and at a specific regional or market level, where the specific impacts of climate change are likely to arise. To illustrate, we want to look to a worked example for the oil and gas sector to quantify the financial impacts for climate risk using detailed and bespoke modeling. The climate risk we consider here is higher tax payable due to increased carbon tax rate. We begin by extracting carbon price projections from climate scenario databases. Then we project the resulting impact on the financial metric. The financial metric is tax payable, and this step entails developing a specific calculation to derive it. This could be Scope 1 emissions multiplied by the carbon price, where Scope 1 emissions are found in the company's environmental reports. The third stage involves calculating the value at stake. The value at stake is calculated as the difference in tax payable between a business as usual scenario with no carbon tax and also two climate scenarios. The disclosure of organizations' forward-looking assessments of climate-related issues is important for investors and other stakeholders in understanding how vulnerable individual organizations are to transition and physical risk, and how such vulnerabilities are or would be addressed. For an organization in the initial stages of implementing scenario analysis or with limited exposure to climate-related issues, the task force recommends disclosing how resilient, qualitatively or directionally, their organization's strategy and financial plans may be to a range of relevant climate change scenarios. Organizations with more significant exposure to climate-related issues should consider disclosing key assumptions and pathways related to the scenarios they use to allow users to understand the analytical process and its limitations. It's important to understand the critical parameters and assumptions that materially affect the conclusions drawn, and the task force recommends disclosing the following elements as shown on this slide. We've just examined the TCFD recommendations focusing on guidance applicable to all sectors. Climate scenario analysis is also important to the financial sector, so we turn now to the CFRF guide on scenario analysis chapter. The chapter represents the output from the cross-industry scenario analysis working group of the UK's Prudential Regulation Authority and Financial Conduct Authority's Climate and Financial Risk Forum. The document provides practical guidance on how to use scenario analysis to assess climate-related financial risk to inform firms' strategy and business decisions. The guide is aimed at banks, asset managers, and insurers of all sizes. The chapter describes current industry good practices, but it is also designed to support those who have yet to fully consider this topic. As we have seen in the risk management chapter, a common approach is to perform a materiality assessment and initially focus on a small set of risks with scope and sophistication increasing over time. This approach holds true for scenario analysis, where it is sensible to start by identifying material exposures, considering simple what-if scenarios before we introduce more complexity. It is for individual firms to determine the best approach for their own organization. The guide is organized into 4 main sections, which we will cover in our webinar and also summarize the key insights. The first section is on climate scenarios for the financial services industry that focuses on the types of questions that can be answered using scenario analysis and how firms can identify their potential exposures to climate-related financial risk. The next section on scenario identification and development will discuss how firms can identify and develop suitable climate-related scenarios, considering their potential exposures. The next section on scenario assessment looks at the assessment of quantifiable risk and deals with how firms can then assess the financial impact of those scenarios on their business. And finally, we will look at the key challenges and barriers facing the financial industry's use of scenario analysis. Before we commence the process of developing and assessing the impact of climate-related financial risk and opportunities, as well as how the results will be used, it is important to be clear what questions or business decision the scenario analysis is intended to help the firm address. For example, climate scenario analysis can help firms better identify climate-related financial risk and opportunities and thereby guide successful corporate strategies. It can also inform how the company will perform under different future states. and a better understanding of the scenarios allow firms to anticipate the macro financial consequences of selected temperature and emission pathways. Others also rely on scenario analysis to test the alignment of a firm's business, investment portfolio, or funds with a specific pathway such as a 1.5 degrees or 2 degrees scenario. A further use of scenario analysis is to examine how much stress a firm can withstand before its business model fails, or what we call reverse stress testing. So for this type of analysis, a firm will design a scenario that tests its business plan to failure. And in the case of a climate-specific reverse stress test, firms might want to consider sources of transition and physical risks that will be particularly difficult for the firm to withstand. For example, how might an abrupt change in consumer preferences impact the firm's profitability? Would this be enough to lead to failure, or should we be also coupling this with other risks such as weather-related disruption? And so in the next slide, we will look at how we can identify potential exposures to climate-related financial risk and opportunities and assess their materiality. The 3 steps involved to identify potential exposures are: first, to examine both physical and transition transmission channels; second, to identify climate-related financial risk and opportunities; and third, to conduct exposure analysis and assess the materiality. When identifying climate-related financial risks, firms should examine how both transition and physical channels could impact their business currently and in the future. The impact will depend on a firm's business model as well as the composition of their balance sheet. Climate change is expected to lead to an increase in the frequency and severity of acute weather-related events, as well as longer-term chronic shifts in climate. A continued rise in emissions will lead to higher average temperatures with significant socio-economic impacts expected below 2 degrees. The direct impacts arising from acute physical events, for example, floods, or chronic physical effects could be seen in the loss of output and cost of repair, in turn hurting the corporate balance sheets. Long-term chronic changes in climate patterns, as well as broader impacts of extreme events, could lead to disruption to a supply chain or support and adaptation costs being borne by the sovereign. This would have indirect effects on inflation, interest rates, and long-term productivity. Transition risks and opportunities can operate through a number of transmission channels. The assessment of these channels may include key components that contribute to lower emission pathways and their economic consequences. For example, the use of renewable energy sources, increased electrification, as well as consumer behavior. For example, less flying, less food waste, adjusted diets. Transition risk channels have both direct and indirect impacts. In terms of the direct impacts, as climate policies would penalize fossil fuel production as well as the production and use of emission-intensive goods and services, firms will face direct risk from stranded assets, negative movements in bond and equity valuations, changes in cash flows, and a deterioration in the credit risk profile of customers in affected sectors. At the same time, climate policies and technological development will promote firms involved in the production of goods and services that assist in reducing emissions. Firms need to assess these negative and positive direct transition impacts. Climate policies will also have broader indirect consequences by changing the prices of a broad basket of goods and services and affecting aggregate patterns of demand and supply. Risk identification is a process used by firms to identify, register, and monitor risks that are relevant to their business model. 2 complementary approaches that firms can take to start identifying climate-related financial risk. So we can either start from the business profile and risk register of the firms and question which business areas or risks are vulnerable to the physical effects of climate change or the transition to a low-carbon economy. For example, how might changes in the carbon prices affect credit risk profiles of firms in the manufacturing sectors? A second way is to start with a future climate scenario and consider how macroeconomic variables such as GDP and unemployment, which are used in existing financial risk assessments, could be affected. Firms need to source relevant data to assess their exposure to material climate risk. For example, having data on the location of suppliers, facilities, customers, and sales is important for transition and physical channels. Firms could also source Scope 1, 2, and 3 greenhouse gas emissions data about their exposures as an initial guide to their exposure to transition risk. To ensure a relevant and proportionate approach with respect to these data, firms may wish to focus on exposures with the highest carbon intensities and longer durations, as well as to examine the type of the financial relationship. For example, is this a lending commitment, bond underwriting, or others? Having considered firms' potential exposures to transition and physical risk, we will examine how firms can identify and develop suitable climate-related scenarios. A climate scenario can typically be described using a combination of the following components. First, socioeconomic context, technological evolution, climate policy landscape, as well as emissions pathways and associated changes in the physical atmosphere. Firms may choose to analyze only one of these components, or may decide that analysis should cover several of these components. This will depend on the context of the business decision needed to be answered, as well as the type and materiality of exposures. The socioeconomic context lays out the scenario backdrop, defining the economy's tolerance for climate change. Technological evolution influences the economy's ability to effect and cope with transition. Climate policies will impact emissions either directly through imposing taxes or quantity restrictions on emissions, or indirectly through regulations on technology, materials, and efficiency. The emissions pathways represent trajectories of greenhouse gas concentrations in the atmosphere. These concentrations result from the interaction of the three previous factors and influence the scale and nature of physical climate